You've heard the story of how the Spanish Armada was destroyed by a storm. You've heard how the British Empire was built on ships and soldiers. That's the version of history we usually get. But empires rarely fall on the battlefield. They collapse somewhere far quieter, on the balance sheet. In 1598, King Philip II of Spain, ruler of the largest empire the world had ever seen, declared bankruptcy for the third time. His armies were still feared, his territories were still vast, but his soldiers hadn't been paid. For centuries, empires have faced the same problem. How do you fight endless wars without running out of money? The solution was never just more gold. It was financial design. Systems, mechanisms, and institutions built to fund power over generations. This is the story of the financial engines that powered global empires and the single invisible flaw that guarantees every one of them eventually fails. We move from the silver mines of the New World to the trade monopolies of Constantinople, and finally to the creation of the world's first national debt market. This is the core lesson of financial history. Power is not decided by who has the biggest army, but by who builds the most resilient financial system. Let's start with the most obvious engine and the fastest one to fail. In the 16th century, Spain appeared to have solved the problem of funding empire. The silver mines of Potosi produced unimaginable wealth. Vast quantities of silver flooded into Europe. The logic was simple. Fight wars using real assets. Don't borrow. Don't depend on creditors. Just mine. This system was built on bullionism, the belief that national wealth came directly from precious metals. But the silver miracle created the first global economic crisis. As currency flooded the economy, the value of money collapsed. Prices surged across Europe. Spanish soldiers were paid in silver, but that silver bought less with every passing year. Spain became a paradox, the richest empire in the world and one of the most financially strained. Wars continued on every front. Mining was slow. War was immediate and expensive. So, Spain borrowed, not from a central bank, but from private international financiers. Loans were secured against future silver shipments. Spain wasn't spending its wealth, it was selling its future. Every delay, every storm, every shortfall placed stress on the system. To service old debt, Spain borrowed more. Eventually, interest payments consumed more than the military budget itself. Between 1557 and 1647, Spain declared state bankruptcy 6 times. This was not a military defeat, it was a financial chokehold. The lesson was clear. Relying on finite assets and external creditors turns power into fragility. When your economy only channels wealth instead of creating it, creditors eventually become stronger than your army. After watching Spain collapse, rising powers redesigned the system. The problem wasn't money, it was trust. Instead of kings borrowing privately, the state borrowed publicly. This was the birth of national debt. Government bonds were backed not by royal promises, but by the stability of the tax system itself. This allowed entire nations to borrow more, for longer, and at lower cost. Debt became a strategic weapon. To manage this system, a central financial institution was created, one that provided liquidity, credibility, and permanence. This was the foundation of modern sovereign finance. But global power required more than public debt. It required scale. So, empire itself was outsourced. Private corporations were granted unprecedented authority. They could trade, tax, fight wars, and govern territory. The public funded expansions through ownership. Risk was spread, power was centralized. It was financial engineering at its peak. But with scale came fragility. Speculation, asset bubbles, and systemic risk became unavoidable. Trust, once weaponized, could just as easily become instability. Now, consider an empire that rejected this model. For centuries, another great power avoided debt entirely. Its soldiers were paid through land revenues. Its economy relied on controlling trade routes rather than borrowing. This discipline allowed it to outlast most rivals. But rigidity became weakness. When trade routes shifted, revenue disappeared. Modern warfare demanded cash, not tradition. Eventually, debt became unavoidable. Financial control passed to foreign creditors, and power followed. Across these empires, the same pattern emerges. Some fell by relying on external wealth. Some fell by refusing to adapt. Some lasted longer by mastering trust. But none escaped collapse. Empires always demand more resources than taxation can provide. The gap is filled by financial engineering. And when the financial design fails, power collapses with it. Trade routes still matter. Debt still determines sovereignty. Global currencies are backed not by gold, but by credibility. Empires don't end when armies lose battles. They end when finances lose trust. History does not repeat itself, but financial logic always rhymes. If this changed how you see money, power, and history, subscribe for more deep stories of finance, debt, and empire economics.